IMF last month noted that the Indian economy will grow slower at 6.2% in FY26 compared with 6.5% projected earlier. World Bank had a similar prediction for the Indian economy. As the world struggles from rising geopolitical uncertainties due to tariff war, how much risk is there to India's growth, especially with the storm closer to home brewing? Moody's ratings yesterday noted that escalating tensions are unlikely to impact India's economy. But a war is never good business. So, how fast can India grow amidst multiple crises? Welcome to Beyond Averages, our weekly data podcast where we try to decode the story behind the big numbers. Today we have with us Gaura Sen Gupta, Chief India Economist, IDFC First Bank, and Paras Chasrai, Associate Director, India Ratings, to decode the health of Indian economy. Thanks for coming on the show, guys. But before we move to our experts, let's first do a status check on the April numbers that we have for now. If you look at it, GSTA collections touched a new high in April of 2.37 lakh crore. This was up from 1.96 lakh crore in March. And if you look at it from last year, it was 2.1 lakh crore. That's about a 12.6% increase, which is in itself a 17-month high. Moving on, UPI transactions were also closer to the 600 million mark with a 34.5% growth from the previous year. Also, the transactions were also higher in terms of value terms, near to 80,000 crores. So where are we now? In terms of manufacturing activity, we have moved higher and reached about a 10-month high at 58.2 from 58.1. This is on PMI. So how is India performing? Let's first go to our experts to understand. What do you make of April numbers? Are they on expected lines, or is this more a tariff-related bump? Gaura, first to you. Thanks for coming on the show.
Thank you so much. So I agree some part of the pickup in April may be related to the tariffs. For example, you see India's merchandise exports, non-oil exports month on month saw a 20% jump. The other aspect is also the fact that if you see for the April last year, we saw a similar year-on-year pickup. So this is a combination, I would say, more a seasonal, because the April GST collections are for transactions that are done March ending. So usually March end, the Q4 quarter, you see a pickup in transactions. So both goods and services. So usually April numbers, the collections are on the higher side.
Paras, coming to you, is this momentum likely to continue in this quarter, and will it continue for the rest of the year as well? And what do you make of these numbers? Thanks for coming on the show, first of all.
Thanks for having Aisha. So as Gaurav mentioned, I mean, this is something which is a seasonal thing, in the sense that March is generally a period when we see a lot of targets being met by various firms and consumer transactions as well. So that's why there is a high bump up which is seen in April. But to coming back in terms of the momentum for the quarter, we think that the tariff impact that would be there. I mean, so far the domestic levers are very strong for the Indian economy, because if you see the growth of real rural wage growth also, that has also remained positive in January and February, and with a good crop season and also the IMD's forecast of above normal rainfall, we think that agriculture would also be doing good. So consumption demand would be the biggest strong domestic factor, and that would be like help so as to say to manage the external front where we see a lot of volatility, especially. So there, I mean, we think that we think that the moratorium that is there in tariff discussions so far, we are better placed compared to other economies. So in terms of coming back to the overall growth numbers, we have kept it at 6.6. So far, but there are like various headwinds, especially with the kind of movements and data developments under there. But nevertheless, India remains the bright spot amongst various major economies.
Now, coming to those numbers, when you say domestic economy is going strong, let me show you a graph here, which is the interesting part. India is a bright spot in manufacturing in terms of PMI at least. 58.2 was India's number, Australia was 51.7, which also rose during this month. China declined at 50.2, Eurozone 49 was high, but it was still in contraction zone. 50 is the line that separates contraction from expansion, and all the other economies here were in contraction. So India did stand apart from others. Moving on, the fastest growing economy aspect of India. 6.5 was the growth last year, which is projected. 6.2 it would be this year. Look at China at 4, that's a big fall. World, which is 2.8, US is 1.8, UK 1.1, and EU at 0.8. So coming back to Paras's point, we are doing better. Now, IMF revised its India's forecast downward, so did the World Bank. But the projections for now keep India's growth at over 6%. Can it fall below that mark, Paras?
Currently, it looks, not something which looks to be on the horizon, because agriculture, even though it is not a very significant part of the economy, but it employs almost the largest proportion of the Indian economy in terms of labor force. And that's why, if we expect, we had also published a research report also that with the IMD's forecast of above normal rainfall, the agricultural growth is also expected, and it could go near the 4% mark and even above that. So, and that will have spillover effects in terms of better rural wage growth, and further ripple effects would be seen in a better consumption demand also in FY26. So, with that happening, it looks, yet difficult that the growth would be slipping below 6% mark. But yeah, the fluctuations regarding forecast has been 6 to 6.5%. So overall, we think that it would be hovering in that range only.
Gaura, coming back to you with the same question, adding a few points to what Paras said. When we talk about consumption demand, a large part of it is also expectations. A war in the offing or an escalating of tensions in the offing, global trade uncertainties, consumption might not pick up as much. Also, the government's recent capex survey put capex by private sector at 25% below, 4.8 lakh crores from 6 lakh crores, near 6 lakh crores in FY25 expected. What do you think of it? Can it fall below 6%?
So private corporate capex is expected to be weak. It's been weak even last year because there was uncertainty on domestic demand. Now with the tariff situation, you also have uncertainty externally. But yes, the one near-term benefit is that the tariffs on India compared to China are are on the lower side, and India has a better trade relationship with the US and is likely to reach a sort of an agreement with the US. So that will help limit the tariff tensions to merchandise, prevent it from spreading into services. But overall, US will continue to target China, so your global growth will be weaker. So overall, we do expect on a net basis, Indian merchandise exports will tend to be lower in FY26. So when you have this situation where you have uncertainty globally, you have uncertainty even on the domestic demand front, because if you look at urban wage growth, they have been slowing in real terms from the second half of FY24. And urban wage growth is very closely linked to how company profits are doing. So, moment you see a slowdown in listed company profits, you can assume that there will be a slowdown in urban wage growth, and that's exactly what we are seeing. Even currently, you look at the limited set of companies which have reported, the non-financial private sector companies, which have reported their results in Q4 FY25, there is a slowdown in profit growth. So urban wage growth is likely to stay on the weaker side, which will impact domestic demand. I completely agree with the panelists that that rural is likely to be slightly better. We are seeing pickup. But again, just because of that uncertainty, the fact that one, you don't know about external demand, you are seeing slowdown in rural, corporate profit growth is not that strong. We expect private corporate capex to stay in the sidelines or to remain tentative. So the weight again remains on the government sector to fill in that gap.
And the below 6% park, is that possible?
The GDP growth. So we've revised GDP growth by down to around 6.3. I would say, let's say the tariff goes back to that reciprocal rate of 26%. And at its peak, when China is 145,
Yep.
everybody else is getting targeted at their peak. Yes, then it can go to a 6%. That's a direct impact of the tariff because it automatically shaves off around zero point 0.5 percentage points from growth. Then you have the second on effect, which is global growth slowing. So I wouldn't say no, but for now, our forecast is ranging from a 6.0 to a 6.3. A 6.3 is assuming a more milder tariff on India, let's say around 10%, what we are seeing during the pause period, and the higher tariffs on China, and you have a little bit of global growth slowdown. So for now, we are still saying minimum of 6%.
Let me show you an interesting aspect here. We compared what happened in 2008 with now, and we got some very interesting aspects here. So world growth had, IMF had projected, this is a difference from the January update. IMF had projected world growth to go down by 0.5% in 2008. It's the same now. US growth was projected to fall by 0.9%. It's 0.9% now. It was minus 1%. China was minus 0.6. India seems to be somewhat better off in this scenario. Gaura, exactly what you were talking about. But even though the world is same, it's a bit different as well. Look at what happens when we look at next year. If you look at next year, 2026 and 2009, and difference in projections, global growth was expected to fall by much higher amounts for all these economies. India stands exactly the same as that. Coming back to the tariff part, Gaura, first to you and then I'll go to Paras on this. The entire aspect is built on the fact that tariffs will kick in, India's tariffs will be lower and services will not be impacted. US President Donald Trump yesterday moved towards the movie business as well. If services come in the fray, how much more the impact could be?
So interestingly, we keep focusing on though India is doing really well on the services front. If you look at our overall net services surplus post-COVID, there has been a structural change where net services surplus is almost countering your trade deficit on a monthly basis. We are seeing 16, 17, 18 billion dollars of services surplus, which has helped keep your current account deficit lower. But the interesting part is if you look at the trade with the US, and this is data from the US, merchandise, because it's a much older form of trade, it's India's merchandise exports to the US is almost double of India's services exports to the US. But yes, if let's say they start targeting the software side, then it will add on. And for example, if the merchandise hit at its peak is around 0.5 percentage points on GDP, if they start targeting the services, then at least you can add on another 0.2, 0.3 percentage points to that hit. But for now, we do feel that the services side is still protected from the fact that US's ability to replace that sort of skilled labor domestically is really limited. So even on the merchandise front, the fact that President Trump announced the pause, the fact that he is willing to do trade deals is because they also realize that their ability to replace the imports via domestic production is really difficult. On the services side, given the level of skill, the number of software engineers, etc., that you require, and the cost point, again, there India has a much higher competitive advantage. So we still feel there could be some non-tariff barriers. We are already seeing that in terms of immigration and the barriers to entry, but we still feel the services side should stay relatively well contained. And moment India reaches a deal on the merchandise side, that will also remove the risk that the US will escalate to services. President Trump is trying to protect, I would say, low-paying jobs, base jobs, while services is a very high-skilled niche sector in the US. So where, again, it's very difficult to replace what India basically can offer because of our demographics, because of the skill level. At least in that sector, we have a clear comparative.
Paras, what if services come into the fray? Also, a lot of our assumptions are contingent on India striking a deal. But we know the US president is also a deal maker. Relationships are now very transactional. What if he strikes a deal with China? Does that then put us back to where we were?
That's like the million-dollar question that anyone can answer right now. But then, yeah, in terms of back to the services part, yes, I concur with Gaurav's view as well that we are much better placed in services, and there it would be, and also one important factor behind services is that uh, based on the kind of methodology that they have applied to correct the tariff situation, the US has been having the trade deficit in the goods part since 1970s, but from that period onwards, it has been having the surplus on the services front. And based on that, if you see, it would be very difficult also for them to put a blanket tariff rule on all the countries on the same methodology that they have applied for goods front. So there, I mean, that's the limited part that that would be protecting India in terms of services, and the services has been resilient so far, and with the kind of different capabilities, especially in other business services such as GCC and all, which is becoming a very critical component of various American business firms, especially financial firms as well. So there, it would be very limited for that matter. And if at all it were to be escalated, then definitely the impact would be
Gaurav, same question to you. What if he strikes a deal with China, right? Your mobile phone exports and your other exports, a lot of it comes from China at present. If US goes and strikes a deal or even reduces tariffs or goes back to the situation before 2024, are we on the same track back again?
Uh, okay, if I think his main pain point is China. He has the largest trade deficit with China, and there's also a security threat that is being perceived by the US vis-a-vis China because of, let's say, in terms of technology, China is in the lead with all the, it files, I think, the highest number of patents globally. There is also a race over rare earth metals. And so in my view, I would still say this whole trade war is not really US versus the rest of the world. It's US versus China. The reason why the second phase that was slightly different, for example, the first Trump presidency, he only targeted China. Then they realized that China was still able to export to the US, but they did it via another country. So now they're just targeting everybody, but the aim is still China. For example, the bilateral agreements that they are supposedly working on, they are looking at rules of origin. Where is the value added coming from? They are trying to ensure that what happened in the first term of President Trump, that reallocation of global supply chains, does not happen again. But if he reads, I guess if he reaches a deal with China, that means that he'll be completely fine with the rest of us. And then again, you'll have back to normal, no reciprocal tariffs, much more lower risk to global growth slowdown. So you'll see some mitigation. But again, I don't see that as very possible because the main target of the trade wars is China. It's not the rest of the world. He's targeting the rest of the world to make sure that the effect is maximum.
Coming back home, more important is not just the global crisis, it's local uncertainty as well. Moody's yesterday noted that India is unlikely to be impacted much by prospects of escalating tensions with Pakistan. But the threat of war turns markets jittery and people cautious. How much of a hit could India take in that instance? Gaurav, first to you, then coming to Paras.
Uh, See, we're always hope that the geopolitical risks remain well contained and we don't see further escalation. That is always the expectation and the hope. And given the fact that agree with the assessment, given the fact that as you earlier highlighted, India, even with a growth cut, India remains one of the fastest growing economy globally. It also remains an economy which has very good financial stability metrics. For example, uh, low household debt to GDP, their fiscal deficit, at least at the center level, the center has been extremely disciplined. It's one of the few emerging markets that post-COVID is actually seeing a steady decline in fiscal deficit to GDP. Inflation in India is really low. Very important, the current account deficit, which is again a very important stability indicator, is below uh, it's supposed to be 0.7%, 0.8% of GDP in FY25, FY26. We are saying a little wider, 1.5%, but it's very low. We have more than adequate FX reserves. So we are very well insulated from escalation geopolitical risk.
Paras, over to you.
Yeah, the situation is quite fluid and dynamic. I mean, so to put a number in terms of what would be the impact if it were to escalate to a full-fledged war, it looks very difficult at the moment. But yeah, I mean, as Gaurav also mentioned that our overall financial metrics and the kind of macro fundamentals are very strong. So that would be helping insulating the overall economy. But if you look at the specific states, there I think the impact could be where if you see specifically the ones which are closer to the border, like northwestern states like Punjab, Himachal Pradesh, Uttarakhand, Haryana for that matter, and even Rajasthan. So these are the ones where could, I mean, face. Some of them are already having a fiscal stress situation, so that could also escalate further. And so yeah, in terms of different states facing the issues, that it could be, but for the overall economy, it would be. They would be able to withstand better in terms of growth because of the overall domestic strong macro fundamentals as well.
So as I understand it, domestic economy is expected to have a good boost, not be impacted so much by the tariff war. India is expected to be that bright spot as it is, right? And growth is expected to stay above 6% until unless something untowards happen. But in the global scenario, anything untowards can happen at any point of time. Thank you for coming on the show. It was great having both of you for your take. We'd love to have you again. Thank you.
Thank you. Thank you.
Indian economy has been doing well until now. 6.5% is what we got last year in FY25. We are looking at 6.2% if you look at IMF projections, 6.3% if you look at World Bank, and 6.5% if you consider RBI's projections. We are expected to grow 6.3% in the coming year as well. The economy is strong and domestic demand, thanks to the fiscal stimulus from income tax cuts and the monetary stimulus from RBI, is expected to help tide over the crisis. At the multiple crisis front, as long as they are contained, India can do well. But can it do more? Is the question. Can we reach the 6.5 mark and go beyond, or will we fall below 6? Those are the risks and the headwinds that we have. Thank you for coming on the show. We'll see you next week. Thanks a lot for watching Money Control.